Hello and welcome to another deep dive. Have you ever looked at a company's stock price and just, wondered how on earth did it get that high? Is it always about amazing products or soaring profits? Or can there be other forces, maybe more, unconventional forces driving things? Because today we're diving into a real market mystery. We're looking at how a company with, frankly, minimal revenue and significant losses can somehow command a multi-billion-dollar valuation. It sort of challenges the basics of investing, doesn't it?
It really does. Today, our focus is Trump Media and Technology Group. That's NASDAQ, ticker DJT. We've got a pretty detailed equity analysis report here, dated July 34th, 2025, and we're going to pick it apart. Our goal, to really understand the story behind this valuation, clarifies some of the very different viewpoints on this stock, and hopefully deliver some real aha moments for you about what drives certain corners of the market. We want to give you a clear perspective on situations like this.
Yeah, I have to say, looking through this report, some of these numbers, they just make you stop and think. Where do you even start when you see a market cap like that sitting on top of such small revenues? Because let's just jump right in. The report's first point is pretty staggering. We're talking a multi-billion-dollar market cap versus just $4.1 million in revenue for fiscal year 2023. And importantly, ongoing pretty big losses, billions in value, millions in sales. I mean, that alone just screams outlier, right?
Oh, absolutely. And what's really interesting here, and the report flags this immediately, is how it labels DJT a meme stock. Now, that's not just, a casual term. It means the price isn't really tied to business fundamentals. It's driven by sentiment, by retail speculation. So you're right. It's less about what the company earns and more about how a specific group of investors feels about it or what it represents to them. It taps into community, identity, maybe even a pushback against traditional finance sometimes. That's really the core disconnect we need to explore.
Right. And the financials really hammer that point home. Okay, revenue did grow a bit, from about $1.5 million in 2022 to $4.1 million in 2023. That's growth. But then you hit the profitability wall, a net loss of $58.2 million in 2023. That loss is just enormous compared to that revenue number.
It is. And we need to be careful about the 2022 numbers, too. The report mentions a $50.5 million profit that year, but it makes it very clear that wasn't cash from the business. It was a non-cash, non-operating gain from complex financial instruments, derivative liabilities. Think of it as like paper gains, not actual earnings from selling anything. The real story is the loss from operations. That was $16 million in 2023, and it was even higher, $23.2 million in 2022. So year after year, the core business is burning through cash significantly.
Okay, yeah, that clarification is crucial. And the balance sheet. As of the end of 2023, the company was technically insolvent, stockholders deficit of $66.8 million. Now, they did get a big cash injection post-merger, right? Something like $759 million cash plus equity.
That's correct.
So that plugged the immediate hole, fixed the insolvency on paper. But the report stresses that doesn't actually fix the underlying problem, does it?
Exactly.
They're still losing money on their day-to-day operations. So even with that cash, what's the long-term picture if they keep burning cash?
Well, it points towards needing more money down the line, and that usually means issuing more stock, which dilutes the value for current shareholders. So why should you, the listener, care about these details? Because understanding these basic financial health signs, revenue, profit, cash flow, solvency, it's absolutely vital. It helps you tell the difference between a potentially solid investment in a real growing business and something that's purely speculative, basically a bet on market sentiment or hoping someone else will pay more later. It's investing versus gambling, really.
That distinction is critical here. Okay, so let's switch gears. What is the actual business behind the ticker symbol? Trump Media and Technology Group. The main thing is Truth Social, launched early 2022. It looks a lot like X, formerly Twitter. Its stated mission is about being a uniting force for freedom of expression, sort of pushing back against big tech censorship. And technically, it's built on Mastodon, which is open source.
And here's something really unusual for a public tech company, especially in social media: their approach to measuring success. The report points out that TMTG specifically says it doesn't track standard industry metrics, things like monthly active users, MAUs, or average revenue per user, ARPU.
Wait, they don't track users or how much money they make per user?
Apparently not in a way they report publicly, or perhaps even internally prioritize in the usual way. And this lack of transparency, it makes it incredibly difficult, almost impossible, for investors to actually gauge the health or growth of the business using normal methods. It's like trying to value a store without knowing how many customers it has or how much they spend. It's a real black box for analysis.
That's a huge red flag for traditional analysis, surely, and market position. The report calls it a diminutive player in the alt-tech space. How small are we talking?
Well, let's put some numbers on it. Truth Social had maybe 1.4 million monthly active users back in March 2024, according to estimates. Now compare that, X, or Twitter, had around 42 million in the US alone, Facebook, over 3 billion globally.
Okay, vastly different scale.
Right, and even within that alt-tech niche, Rumble, another platform, has slightly more users, 1.7 million MAUs, and way more engagement, like 13.3 million minutes spent per day versus just 1 million on Truth Social. So it's not just small compared to the giants, it's not even leading its own specific category.
And the user base itself is quite specific, according to the report. About 65% are over 55, mostly male. And here's a fascinating bit. Huge overlap with other platforms. 87% also use Facebook, 56% also use X. So if we step back, what does this narrow appeal and high overlap mean for their growth prospects? Can they break out?
It creates a really significant structural hurdle. To succeed long-term, social media platforms usually need broad appeal to get those powerful network effects, more users, attract advertisers. But here, the very thing that attracts its core base, its strong political identity, is likely what prevents it from attracting a wider audience from mainstream advertisers who might be wary of the association. It's almost like a built-in ceiling on its growth potential in the broader market.
Okay, this is where it gets genuinely fascinating, maybe that aha moment. We have minimal revenue, big losses, a niche platform with limited reach. So how on earth does that translate into a multi-billion-dollar market cap? What does traditional finance even say about a situation like this? It feels like the rules don't apply.
Well, traditional finance says it's disconnected from fundamental value. Hugely disconnected. The report dives into this using standard valuation methods like discounted cash flow, DCF. And basically, it concludes any DCF analysis trying to justify the current price becomes, and I'm quoting here, an exercise in reverse engineering.
Meaning you have to make crazy assumptions to get the answer you already see in the market price.
Exactly. You'd have to assume revenue explodes from $4 million to billions within 10 years. That means growth rates of like 100%, 200% every single year sustained. And on top of that, achieving profit margins like Google or Meta are in 20, 30%. The report is blunt. There is no evidence in the company's history or strategy to support such assumptions. It's just not grounded in reality.
Wow. Okay, so DCF is out. What about comparing it to similar companies? Relative valuation, like price to sales, since they don't have profits.
Yeah, the price to sales ratio, or PS, is maybe the most relevant metric here. And for DJT, it's absolutely astronomical, roughly 1,600 times its annual sales. Let me repeat that, 1,600?
1,600 times revenue.
Yes. Now, compare that to Rumble, its closest peer in the alt-tech space. Rumble trades at about 4.5 times sales, and the big, profitable tech giants like Meta, single digits, maybe 5, 6, 7 times sales. So DJT is trading at a premium of more than 350 times its nearest competitor, just based on revenue. It's completely off the charts.
So no matter how you slice it, DCF or relative valuation, the conclusion is stark. The report sees DJT as fundamentally profoundly overvalued. What does the report actually estimate as a more realistic or fair value per share?
Based on those fundamentals, the report estimates fair value is likely less than $5 per share, possibly even below $2 per share.
From a market price that's been, many multiples higher than that.
Precisely, and it circles back to the core idea. Its value is derived from non-fundamental factors. The current price is not a reflection of business value, but a real-time barometer of political sentiment and a vehicle for retail speculation. The market's pricing the sentiment, not the business.
And that really sharpens the question for you, the listener. When you look at a stock like DJT, are you actually investing in the underlying business? Or are you participating more in a social or political statement? Or maybe just riding a wave of sentiment? It's a crucial distinction to make. Okay, so if the valuation seems detached from fundamentals, what about the risks involved? Let's shift to that minefield. The report starts by saying there's no economic moat. Can you explain what that means and why it matters?
Sure. An economic moat is like a protective barrier around a company's profits. Think of a strong brand. Patented technology, network effects, high switching costs, things that keep competitors at bay. The report argues TMTG has none of these. Its brand is totally tied to Donald J. Trump, which is actually listed as a liability or key person risk, not a competitive advantage in a business sense.
Right.
It lacks network effects because its user base is niche. And there's no special tech. It's built on open source stuff. Essentially, there's nothing stopping someone else from creating a very similar platform. There's no defensible edge.
And what about the people running the show? Management and governance. The report mentions CEO Devin Nunes' background in politics and agriculture, not tech, and the board having similar political connections rather than seasoned, independent tech executives. Why is that flagged as a risk?
Well, for any public company, you want a management team and a board with relevant industry expertise. People who understand the technology, the market dynamics, the competition. And crucially, you want independent directors on the board whose primary job is to look out for all shareholders' interests, provide oversight, and ensure sound strategy. When the leadership is heavily drawn from political circles without that deep tech or media background and lacks strong independence, the report suggests it raises questions. Questions about strategic direction, operational competence, and whether decisions are always purely business-driven.
Which leads directly into what the report calls the single biggest threat: key person risk.
Absolutely. It's stated very clearly the company's fate is wholly dependent on the popularity and reputation of Donald J. Trump. Any event, political, legal, personal, that negatively impacts him could directly hammer the company's prospects and its stock price.
It's an extreme concentration of risk in one individual, isn't it?
It really is. For most companies, there's some resilience if a key figure departs or faces issues. Here, it seems almost existential.
Okay, we've touched on the meme stock, volatility, and the concentrated ownership, but there's a specific time-sensitive risk related to that ownership: the lockup expiration. What's that about?
This is a big one to watch. Typically, after a company goes public via a merger like this, insiders, including major shareholders like Trump, are locked up. They can't sell their shares for a set period, usually 6 months. For DJT, that lockup period ends in late September 2024.
So just around the corner, relatively speaking.
Exactly. And when it expires, a huge number of shares held by insiders will suddenly be eligible for sale. The report warns this could create a massive supply dump onto the market, potentially overwhelming demand and causing a significant risk of a price collapse. Add to that the stock's incredibly high, beta 4.75. That number means it's expected to be almost 5 times more volatile than the overall market. Extreme swings are basically baked in.
And then there are the ongoing issues. They're still losing money, so they'll likely need to raise more cash, probably by selling more stock, diluting existing shareholders. Plus, they face intense competition from platforms with vastly more resources and all the swirling legal and political issues.
And the really dangerous part, according to the analysis, is that these risks weren't isolated. They're highly correlated, meaning trouble in one area can easily trigger problems elsewhere. A political setback could hurt user numbers, which could spook advertisers, which could tank the stock, making it harder to raise capital right when the lockup expires. You see the potential chain reaction?
Yeah, cascading effect.
Right. The report warns of potential rapid and severe destruction of shareholder value because these risks can feed on each other.
So let's try to wrap this up. This deep dive, based on the equity report, paints a picture of DJT as a company that really defies normal financial logic. You've got financials like an early-stage startup, no clear competitive advantage or moat, and leadership primarily from politics, not tech.
And the conclusion from this particular analysis is pretty stark. For someone looking to invest based on solid business fundamentals, DJT is described as basically the antithesis of a prudent investment. The report suggests the risk of losing a significant portion or even all of your capital permanently heavily outweighs any chance of further speculative gains. The formal recommendation in this July 2025 report: a clear sell with a 12-month target below $2. It's a strong warning signal about separating sentiment from substance.
Which leaves us and you with a final thought to chew on. What happens to a stock like this when the political winds change, or when the sheer weight of those financial fundamentals becomes impossible for the market to ignore any longer? How do you, as an investor or observer, draw the line between investing in a business and participating in something driven purely by sentiment, speculation, or social identity? Thinking that through is key in today's often confusing market landscape. To make sure you don't miss crucial insights like the ones we discussed today and get the fastest updates, be sure to subscribe to The Deep Dive. We appreciate you joining us, and we'll catch you on the next Deep Dive.